The Fibonacci sequence is a series of numbers in which each number is the sum of the two preceding ones, usually starting with 0 and 1. In trading, Fibonacci retracements are used to identify potential levels of support and resistance. These levels are calculated by taking the high and low of a price move, and then dividing the vertical distance by the key Fibonacci ratios of 23.6%, 38.2%, 50%, 61.8% and 100%. Fibonacci retracements are often used to help traders identify when to enter or exit a trade by looking at these key levels. The theory behind this is that prices will often retrace a predictable portion of a move, after which they will continue to move in the original direction. For example, if a stock's price moves from $10 to $15, then retraces back to $12, a trader may consider this a potential level of support as it falls within the 38.2% retracement level. If the stock's price then bounces off this level and resumes its upward trend, the trader may consider it a good opportunity to enter a long position in the stock. It is important to note that Fibonacci retracements are not a guarantee of future price action and should be used in conjunction with other technical analysis tools and fundamental analysis. It is also important to note that Fibonacci retracements should be used in the context of the broader trend, and not in isolation.